Another week has gone by and another small underperformance by the couch investing portfolio. Now, of course, as you will know, this is only episode number 4, so still quite young, and I do believe that most of my positions here, if not all, will outperform the market in the long run. In the short term, yes, I do expect to take some hits. That's why I still have close to 10% of the portfolio in cash, to look for those nice little dips, to look at those crashes, and maybe buy the dip. Because if you look at the positions here, a lot of those, Snow, Adobe, Palo Alto Network, for example, all of those positions were created because the stock dropped quite a lot in a day or two. And like I said in the previous episodes, I do want to keep this portfolio between 10 to 15 positions. That means that in the coming weeks, on months, if suddenly there are some positions that have moved up quite a lot, whether it's the short-term bets or maybe the positions like Apple, which I use basically as a sort of cash position with maybe some growth, also buying the weakness there, meaning I could see a bit more upside in the coming quarters, as I still believe they will be announcing their next suite of products, market them as AI products. I do think that with a weaker start of the year for Apple, we might see a better performance for this stock in the back half of the year. And it's a bit the same with every other company that I own here in that portfolio. Yes, Baba, it's me being a contrarian and saying, look, I do still think that there is quite some value there, despite it being a Chinese company. I do still think that at the price I bought, which is basically the same price it is at right now, I do still think there is a bit more upside to, well, compared to the risk attached to that. So moving forward, there might still be some changes. Just like you've seen last week, I sold out of Coupang. Someone asked, are you bearish on Coupang now? No, I'm not bearish on Coupang, but as I mentioned before, this was basically me betting on quite a solid quarter, plus not really knowing whether or not I would like to keep it for the long term or not. The stock has outperformed other positions, and so I took those profits and invested in other positions. Again, I would like to have the top 5, top 6 of this portfolio to be the core of the portfolio, and then all the rest will probably be long-term bets, such as Appcelera and Rocket Lab, and I've recently added actually Funko, which I'm going to talk about in a bit. So Funko I added, I believe, at $6.21, 500 shares. Currently, it's up 2.42%. Again, very, very small position in this portfolio. Yes, it is a bit more than Palo Alto, but Palo Alto, I'm still studying that field. Probably I will increase that position over time. I do also want to address one question that someone asked. By the way, feel free to share your feedback, ask questions in the comment section below. That's why I make these types of videos. So it's all a learning process. Now, one person said, find this a bit weird that now lots of creators, let's say, are starting these types of videos, these types of portfolios when the market is extremely high. He mentioned Feroldi started that back in 2020, 2021 or something like that, near the top. He finds it a bit strange. Well, funny enough, I also made a portfolio, if you remember, back on stockcar.io. The screenshots will be on the screen right now, and you can clearly see the outperformance of those portfolio, despite me starting those portfolios quite close to the peak of the market. And just like with this one, I don't really care if I'm starting this portfolio at near all-time highs. Clearly, the positions that I chose right now, the companies that I chose right now, are not at all-time highs, or at least not all of them. Most of them have actually had quite a bad start of the year, which is probably why I should call this portfolio a buy the dip portfolio right now. But moving forward, I do still think there is a lot of strength with those companies. So that said, no, I don't find it strange that starting these types of portfolio at near all-time highs for the market should raise some orange or red flags. On the contrary, would you rather me start a portfolio when everything is down 50-60%? Because then it's pretty easy to outperform the market. I think starting at near all-time highs is way more challenging. And if I can show you that even investing at near all-time highs, retail can outperform in the long run, I think that would be mission accomplished. Again, there's no guarantee that I will accomplish that goal, but I'm pretty confident I can try my best. Now, first up, I want to touch on the company that makes these types of things. Yeah, this is from Dragon Ball and Dragon Ball Z. The company is called Funko. It makes Funko Pops, vinyl pops, stuff like that. The company right now has a market cap of $338.5 million. If you remember, I talked about this company quite a long time ago. Since then, the company has had some internal issues, some issues as well with regards to inflation, shipping costs, etc., and then, of course, demand. But right now, I do still think that under $500 million with an EV to sales ratio in the next 12 months of 0.6 times, I think it's fair to say that the stock is quite cheap. I don't think this company will go bankrupt. I think they are moving into the right direction. If you look at what the analysts are expecting for the coming fiscal years, for this fiscal year, sales will be down, EPS negative. But if you look at fiscal year 25 and 26, sales should accelerate, not by much, but EPS is becoming better and better, and that's the most important point. Now, if you look at their latest earnings report, you can clearly see here, like I said before, net sales is down for the quarter year over year and for the full year 2023 and 2022. Net income loss also for the quarter a bit better, year over year not so much. But as they said in the recent earnings call, they addressed significant existing operational issues and executed a comprehensive cost reduction plan. The plan included eliminating unprofitable product lines and SKUs, 2 rounds of workforce reductions, and aggressive reductions in our inventory levels, which I'll return to in a moment. The major elements of these transformations are now complete. So, growing the direct-to-consumer business remains a key goal for them. They have more control over direct-to-consumer business and believe they can grow it profitably. So they are pleased to see D2C sales in Q4 comprise 26% of the mix and increased nearly 30% over the same quarter last year. They have expanded their product offering, one offering Bitty Pop, which is basically a Funko Pop but a miniature one, and then to a thing called Pop Yourself Online. Both products have been very well received by customers and were key contributors to their business in 2023. Number 4, on the operational front, they achieved another important goal, lowering the company's own inventory levels. At year-end, inventory was $119 million, which was down more than 50% from the $246 million at the end of 2022. And for a larger retail partner who provide us with point-of-sale data, in the channel at the end of 2023 was 32% lower than at the end of 2022 and at healthy levels relative to POS sales. So that's already good. That's a great start to the year. Turning to 2024, they expect full year net sales to be comparable to down slightly from 2023. Regarding phasing of the quarters, they expect to achieve positive comps later in the year, but for Q1, net sales to be lower than net sales in Q1 of last year. Second, they are experiencing a softer content schedule, primarily due to the recent Hollywood strikes. Basically, every time there's a new show, a new movie that comes out, they are coming out with new Funko Pops. Makes sense. If the movie does not come out or there's a delay, they cannot sell more and more products. But most importantly, they expect 2024 full year adjusted EBITDA to be considerably higher than their 2023 full year adjusted EBITDA. And that was one of the main reasons why I actually started a small position in that company. I think the stock is way oversold, too much fear, and so I took advantage of that. If we look at the graph on the weekly, I zoomed out completely. You can clearly see that every time we were at around this area right here, besides here back in 2020, this area was a good area of support. So I took a bet, and now let's see how that plays out. Up next, I want to touch on companies that I've added a little bit this week. First off is obviously Adobe. I made a video about Adobe this week with regards to their earnings report. Stock was down 14% or so after the earnings report. If you want to watch the full review, the video will be in the top right corner. Basically, right now I've got 20 shares, cost per share $518. I will probably accumulate more shares as the stock goes down or starts to stabilize. Now, with regards to Adobe, now you can clearly see that today, compared to its 5-year mean, the stock is now a bit cheaper after that 13-14% drop on all of those metrics now, besides price to free cash flow, but that's in the last 12-month metric. All the rest are lower than the 5-year mean. Now, you might say 26.8 times is still expensive. Okay, could be, but in my opinion, right now at $222.8 billion in market cap, having now announced another $25 billion share buyback program, which is now more than 10% of the company, in my opinion, it's an okay price to pay. Now, for those that are saying, yeah, but AI will disrupt the whole business, let me tell you one thing. If you're using one of Adobe's products, you know that AI is at the core of their product offerings. Adobe is not sleeping on Sora or Midjourney or all of those things. No, they've addressed that. I've talked about that in that video. So again, I'm not going to repeat myself again and again. I do still think that Adobe will still be the #1 leader when it comes to everything creative. Up next, and this will be a quick one because I just released a video on SoFi. That's the #3 position right now in the portfolio. I'm down 8.6%. Average cost per share here is $7.69. Currently, I'm comfortable holding that. I still believe that in years from now, having a cost basis of $7.69 is going to look very, very cheap. If we drop lower and lower, yes, I will probably consider to add more. Just a quick FYI, as for the rest of the positions, Rocket Lab, Appcelera, Palo Alto Network, Intel, Alibaba, I have not been adding any new shares to those positions. With regards to Snowflake, it is now under $160. I might consider adding a bit more in the coming days, depending on the market situation. Right now, the average cost per share sits at $173.22. So I'm down 9.4% on that position. Again, I do still think that guidance was sandbagged because they want the new CEO to succeed. And yeah, now it's just a waiting game. As for Apple, that position is down 3.61%. Not that much. Like I said, this is basically a secondary cash position with some possible upside in the second half of this year, plus lots of buybacks and a little dividend. As for Google Alphabet, I remain extremely bullish on that position. Currently, it's only up 1.68%. Average cost per share sits at $138.84. In the last couple of days, the stock has gone up and outperformed many of the other positions. This will probably be a long-term hold unless something major and drastically changes for the worse in the coming quarters. I don't think that will happen. I've made plenty of videos in recent weeks about Alphabet, why I do still think this is one of the most obvious buys of the year. So go ahead and watch those videos. And as for PayPal, it's the #2 position of the portfolio. It's up 7.16%. I've talked about PayPal this week, why suddenly there is a move on the upside for the stock. It has to do with what the CEO has been saying this week in a conference. That video is also already live on the channel. Basically, guidance might have been sandbagged as well. They are seeing some positive results from everything that they're doing. Remember, this is new management, completely new team. So yeah, it makes sense for them to put the bar quite low so they have some flexibility and they have some room to beat and maybe even raise guidance. I still think that risk reward wise, PayPal probably one of the best right now in the market. That's not to say that the next position, which is Tesla, is not a good one. But as I said, and as I keep saying in my weekly videos about Tesla, just because right now it has a horrible start of the year, I think it's down 30+% year to date. This position right now is down 11%, average cost per share at $184. If it drops lower, under 150, that's probably where I'm going to buy aggressively. If it doesn't, that's fine as well. We've had plenty of positive comments this weekend with regards to the new release of the new version of FSD, still in beta mode. Although some people like to downplay the fact that, oh, it's called full self-driving, but it cannot fully drive itself. You still have to put your hands on the wheel. Yeah, okay, fine. But even on the website, it tells you exactly its full self-driving capability, meaning it is capable of full self-driving. And if you've watched the countless of videos, hallmarks, by the way, goes from home to work or to a coffee shop, doesn't matter what, does not touch the brake, does not touch the accelerator. Yes, you have to put your hand on the steering wheel. That's for safety purposes, meaning you're not falling asleep, you're not on your phone. No, you are still responsible right now for your driving, which makes sense. That's why it's in beta mode and not released into the wild. You can sit in the back. No, you still have to sit in the front. So yes, legally, officially, this is still L2. And no, I haven't seen any other car manufacturer out there that can do this perfectly. So there is that. Plus, like I said in the previous Tesla videos, Q1 is not going to be a good quarter. Now, with the announcements of small price increases in the United States and Europe, Maybe that, well, not maybe, that will definitely help with EPS going forward, but don't expect some magical things to happen already for this upcoming earnings report. Maybe in the earnings call we are going to hear something more positive, but don't get your hopes up, because as long as interest rates stay extremely high, as long as we do not have rate cuts, Elon will keep on repeating the same thing again and again. People that will buy cars will not buy a car with, well, cash up front. No, they're going to do this by financing. And since rates are still high, most of the people cannot afford that. So he's going to repeat the same thing again and again, plus the fact that the sentiment around EVs is changing just a tiny bit. 2024 is a year where you have to reset your expectations. That's why I said it at the start of the year. Reset your expectations. 2024, flat year. Yes, down revisions are normal. You cannot have a stock trading at a high valuation when growth is basically close to non-existent, which is why we've seen valuation metrics such as forward PE, EV to EBITDA, price to sales, price to free cash flow, and even the PEG ratio come down since the start of the year. At the start of the year, forward PE 60.5 times. We're now still at 52.2 times. My opinion makes a bit more sense to look at something like enterprise value to EBITDA in the next 12 months. Start of the year 35.4 times, now 29.3 times. If you want to compare to the 5-year mean, clearly from a PE standpoint, we're, well, cut in half. EV to EBITDA, cheaper. Price to sales, cheaper. Price to free cash flow, cheaper as well. Still expensive overall. And of course, you might say, yeah, but before this company was growing, right, over 50%, was growing extremely fast, so a high PE made sense. I can agree, but as long-term investors, you're not really looking at the next 6 months or the next 12 months. You're not a money manager. You're not looking for those short-term catalysts. You're looking for the next decade plus. So in my opinion, if we can get and we can acquire, that's just me personally because I'm still bullish on Tesla. If you're not bullish, then you shouldn't really touch the stock right now. I'm still bullish for the long term. So anytime I see a lot of weakness, a lot of negative sentiment around this company or around plenty of other positions in that portfolio, I like it and I'll continue to add accordingly. And so to conclude, while right now this portfolio is underperforming, again, with the positions that I took, with the performance of those companies since the start of the year, I think that probably in the back half of the year, we are going to see some major shift in sentiment around this couch investing portfolio. At least that's what I'm betting on. I'm betting on those companies outperforming the market in the long run. In the short run, I'll continue to accumulate and maybe make some little changes here and there. And hopefully I can move from a couch to a nice premium lazy boy. So that will be it for this video. Of course, do share your feedback, questions, you name it, critics as well down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.